Patel Engineering Limited. Today we're going to analyze Patel Engineering Limited's latest conference call where the management talks about how much revenue and profit they're expecting this year and next year, plus many more important things about the company. So we will analyze this con call. And just a quick up, an earnings conference call is basically a conference, a meeting where shareholder and management meets. Shareholders ask management questions and management answers the questions. So this is page 2 of the con call. Let us start. So first, order book. Okay. Order book. As of September 30th, 2025, our order book stands at around 15,146 crores. So the current orders that they have from customers on hand right now is 15,146 crores. We have submitted tenders, that is bids, of around 34,000 crores, which are currently under evaluation, and we expect it will be open in coming few months. So currently, orders under evaluation being bidded are 34,000 crores. Projects being bidded. Further, we have projects identified of around 18,000 crores, which are in the pipeline and expected to come up for bidding in near future. So 18,000 CR worth of projects expected to be up for bidding. Not right now being bid, but being up for bidding. And finally, this is apart from a list of tenders of more than 1 lakh crore worth projects which will be coming up for bidding in the near future. We are hopeful of achieving our target order inflow of around 8 to 10,000 crores in the next 6 months. So in the next 6 months, they expect and they're hopeful to win around 8 to 10,000 crores of new orders. All right. In the near term, they're seeing around more than 1 lakh crore worth of projects. And even in the more near term, like very near term, they have around 18,000 crores of projects they will be bidding for. And currently, they are bidding for 34,000 crores of projects. So, a lot of projects. Then let us move to page 5. Now, the board of directors has decided to raise fresh capital of up to 500 crores via right issue. So they're issuing more shares of up to 500 CR. I believe rights issue means that, and that will dilute existing shareholders. Why are they doing that? First, this will ensure that all existing shareholders are given an opportunity to invest. These funds shall be utilized for debt servicing, paying down existing debt, so that cash flow from operations shall be available for deployment in new projects as we expect huge inflow of new orders. So they're expecting huge inflow of new orders, which will need more capital, more money. So they will raise this 500 crores. They will use this to pay down existing debt, reduce the amount of debts so that there's less interest cost, less interest payments. And this will free up their cash flow from operations as this cash flow will not be needed to pay down debt, not be needed to pay down interest. Now, let us move forward regarding cash flows. This is a question asked by an analyst. Cash collections were very robust in the first half. What happened there? The receivable days are down to around 52 days. Is that sustainable? Good question. So, what are receivable days first of all? Receivable days are the number of days it takes for a customer to pay back the company after the company has already supplied them the product. A company has supplied product to a customer, it gives the customer a credit term. The customer can pay for the product after a certain period of time, predetermined of course, and so this came down to 52 days. Lower this number, the way better it is for the company. Lower the receivable days, faster it gets money from customers, better are the company's cash flows. So the answer for this question is, so see the first half for the year has been pretty good, and generally the last quarter is also good. So we see that receivable days between 45 to 60 days. So that should be there. So that should be there. So this should be sustainable. It's going to exist 45 to 60 days. And why is this important? It is revealed in the next question. That is a meaningful change from earlier, right? Because we were at 114 receivable days a few years ago, then down to 80 receivable days, and down to the high 60s. Now you're saying that 45 to 60 going forward is sustainable. Is it part of the contract? Receivable days going down is very good. Is it sustainable? Now has change come? And the answer by management themselves is yes. So once the bills are getting certified, they're getting paid in 45 to 50 days. So receivable days have come down to 45, 60. That is a huge win for the company. Now comes margin, profit margin. So question comes, what is the margin outlook ahead in H2? What is H2? H2 means second half of the fiscal year, that is quarter three, quarter four. So from October to March, what are the profit margins looking like? Answer by management, a margin outlook will be similar, 13 to 14%. All right, 13 to 14% profit margin they are looking to maintain. Then we go to page 12. All right, this is the best part. Best part. Question. Understood. And sir, any guidance for fiscal year 2026? What will be the top line, that is revenue, and margins look like for the balance 6 months? So we are currently in fiscal year 2026. Yes. So the analyst is asking, what is going to be the revenue like for the whole year? Now, answer is, so this year we are given because of last year's order inflow was less. Last year's order inflow was less, so only marginal growth around similar 5,000 crores as last year and margins around 13 to 14%. So management is expecting profit margins 13 to 14%, but total revenue for fiscal year 2026 to be around 5,000 crores, same as last year. So this year they're expecting like almost no growth, really, like flat revenue, not a lot of growth. Okay, this year is not going to be like a growth year. Year is going to be a flat year. So now you can expect what kind of growth will be coming in quarter three and quarter four. Now, the interest cost, the interest payments that they're estimating for the full fiscal year 2026 is around 75 to 76 crores a quarter, around 280 to 300 crores ish of interest payments for fiscal year 2026. And that's a good thing because last year they were around 330 crores, so around almost a 10% reduction in total interest costs. That's a good thing. That was page 13. Now let's go to page 14. Now this is the juicy part. Fiscal year 2027, that growth. So question asked, understood, great. I saw in your deck, investor deck, where 25% of the projects are 50 to 70% completed and 20% of the projects are 30 to 50% completed. Presumably, fiscal year 2027 and fiscal year 2028 should be big years for the company. Is that correct in terms of revenue growth? Yes, we are expecting that. All right. So it has a big order book right now. I think around, what was the figure? 15,000 crores ish of order book. So of that, 25% of those total orders, 50 to 70% completed. 25% of projects are 50 to 70% completed. Other 20% of the total projects are like almost 30% to half completed. And management confirms that they're expecting fiscal year 2027 and fiscal year 2028. Fiscal year 2027 starts around April 2026, ends around March 2027, and fiscal year 2028 ends around March 2028. These years are going to be big years for growth. They're expecting that. And finally, another question regarding this growth. All right. And also, can we reach like again 6,000 crores or around 5,500 crores of revenue by fiscal year 2027? And maybe like a 15 to 16% EBITDA margin? He's asking. So the answer is the first target is that only 10 to 15% growth we get next year. So fiscal year 2026, as I said earlier, flat growth. Fiscal year 2027, that is the next fiscal year or the next year, we're expecting around 10 to 15% growth only. And then margin profile, similar profit margins of around 13 to 14%. Is it EBITDA? Is it net profit? I'm not sure. I think it's EBITDA, but you could check it again. Uh, that's it. So as a summary, they're raising capital, There'll be some, I think, shareholder dilution where it will be used to pay down debt, which will help free up cash flows. And cash flows seem to be, I think they will improve because receivable days have come down. So that's positive for cash flows. And as for revenue growth, this fiscal year flat, next two quarters, you can try to evaluate the type of growth they will have based on if the full year is going to be around flattish, and then fiscal year 2027, 10 to 15% growth. And I guess fiscal year 2028 will be the best year, I guess. The better year, the more growth year.